In the name of God, most beneficent and merciful, peace be upon all of you wonderful people. Good morning, good afternoon, and good evening, ladies and gentlemen, wherever you are across the globe. Thank you for making the time to spend with us on this wonderful topic. For those who don't know me, my name is Dr. Ebaad Momin. I am a director at Rehbar Financial Services and Step Up Ventures and a partner at Mount Rudy Ventures. These are three institutions that are working in the field of alternative finance, which allows value-conscious investors and capital seekers to do so, remaining on their value system. And when I say alternative finance, we work on structures that are within the framework of the value framework which we've laid out, and are within, and very importantly, are within the realms of the Indian legal system. So as a first of the series, we've tried to keep this webinar fairly basic and simple, and encourage you to ask as many questions as you want to. The question and answer tab is available. You can post in your questions at any point in time. For the ease of this, we would take all the questions right at the end after the panel discussion. So jumping right into it, what I would do is I would take you through a few common financial mistakes which people make, all of us make. Some of us make it again and again. Some of us make a little few of them. What are the various financial asset classes? When I say asset classes, I mean, what are the types of investments or the categories of investments which one can make? What is ethical or social responsible investing? I'll just breeze upon that. And why on how should a person plan for life's contingencies or life's plans? And lastly, we'll have a panel discussion with a couple of doyens of the finance space, Mr. Sherif, Kottapurath, and Mr. Kazi, Arif, Zaman. So one of the most common mistakes which people make is ignorance and procrastination. Now, people have generally stayed away from finance for a couple of very simple reasons, right? One is this, that it overwhelms them, one. Or two, because in lines with their values and certain misconceptions, people have actually stayed away from this, saying that, this is not in the part of my value system and I will stay away from this as far as possible. But what we'll try and do is we'll bust this myth, or we will try and demystify to whatever extent which we can here. So investing or finance is just not one concept, right? You can actually break it down, whether it's in terms of budgeting, cash flow planning, savings, and then comes investments. The second big mistake which people make is, and which is very common amongst business people, which I've seen in my limited career of about 15, 17 years, is this, that a lot of businessmen have family assets in the name of the business. So whenever they need, they will take out money from the business and put it for a family need. And whenever they have a business need, they'll take out money from the family corpus and put it into the business. Now, sounds all right, but what really happens is businesses go through cycles. You can't, and if the cycle is bad, and if your son needs money to go and study, you are going to be left helpless. Or if there is a family emergency, you're going to be left helpless. So lack of differentiation between business and family assets is one of the bigger mistakes which people make, especially businessmen. Underestimating life's contingencies. Now, things like, we know that we're going to die someday or the other, but not many of us actually plan. Now, when I'm saying planning for it, means how are you going to create a corpus and how are you going to structure it, right? A lot of us actually plan for it in the sense that we invest some amount of money or buy some real estate or whatever, but there is no structure to it, right? When I say structure to it is, I've seen umpteen number of cases where, families start quarreling amongst each other because they don't know where the papers are, or they don't know what the title is, and so on and so forth. So I'll just go over these over a period of time. lack of tax planning, one of the major financial mistakes. And I say tax planning and not tax evasion, because the idea is no breaking any law, but there are a number of ways where you can reduce your tax incidence and ensure that you still invest properly. And these are four broad areas. The fifth area is, I've highlighted it differently because a lot of us fall into this space, right? And it's a lesser problem, but still needs to be addressed. We do invest in some way or the other, but we invest without a plan, right? The first mistake is over-reliance on one's knowledge. And it's a human tendency, right? Whether it is with respect to finance or whether it is respect to anything else, we think that we know more than a lot of other people. Now, with respect to finance, what really happens is there are a lot of people who pose as, financial advisors per se, and they will come to you and all they do is push products to you, right? So yes, you have to be careful whom you take advice from, but it is a cardinal error where if you're not going to consult other people on what is happening in the finance space, there is a great likelihood that you might go wrong. Investing on emotional grounds, like how many times have we had nieces, nephews, some uncle coming up and saying that this is a great investment, come and invest, right? And we've got no clue where the investment is, what it is, and so on and so forth. It's a very fundamental error which goes around, but it is. Herd mentality and fear of missing out. A typical example which I can take here is we operate out of a place called Bangalore, and unfortunately we are infamous for Ponzi schemes, right? And a lot of us hear that, what, my neighbor has made so much amount of money by investing into this asset class or this particular investment. And when you keep hearing these stories, time and again, you tend to go and flock towards that, saying that, we don't want to miss out on this, and we don't want to look like fools in social events. So the problem is we don't understand the risks associated with different investments. And I'll come to I'll dissect each of these risks down. These are not the only risks, but they are one of the few of the majority of them. Not paying enough emphasis to inflation. Now, what is this animal called inflation, right? So today you have 100 rupees in your pocket, and that can buy a certain set of commodities or goods, right? Tomorrow, 1 year down the line, this 100 rupees will not be able to buy the same quantity. And this is because of inflation, or we call it mehengai, as we call it, right? So we don't pay enough emphasis to inflation, and we let our money lie in our savings account or our current accounts, just hoarding money, not looking beyond traditional investments. I mean, how many times have I looked at people and asked them, really big people, and they've said that there are only 3 asset classes which they invest into: 1, gold; 2, real estate; and 3rd is their own businesses. Which is significant, which is fine. Real estate has made great returns over a period of a decade or so. But you need to look beyond these traditional investments, because there are much better investments which have come up, or during a particular period of time, they may perform slightly bit better with a lesser risk installed as well. Not taking a portfolio approach. Haven't we heard about not putting your eggs in one basket? Investing is a similar kind of a scenario. You have to take a portfolio approach where the risks associated with one investment, when brought together with another investment, comes, or when they interact with each other, the overall risk of your portfolio comes down, whereas the returns may remain the same. So it is very essential that you diversify your risk in various asset classes and various baskets, right? That's where I was coming from: a risk of diversification, lack of diversification where people don't diversify, and rebalancing. Now, what really happens is, although you may diversify into various asset classes, it's very essential to keep track of these asset classes, what's happening, because the world has become so connected that, when the US sneezes, the Indian stock market goes down, right? So what you need to do is you need to take out certain investments from some place, if it is possible, redeploy it in some other place, and so on and so forth. One thing which is very important is that one size does not fit all. So something which may work for Mr. Kazi may not work for me, because our ages are different. We need money at different points in time of our time, right? So we need to take that into consideration. Lastly, and very importantly, not investigating enough if an investment is consistent with our value system. Now, for people like me, I invest my money in lines with my value system. When I say my value system, it means that I am not going to invest into something which is going to be socially irresponsible. I am not going to go and invest in a arms and ammunition company. I'm not going to invest in an alcohol company or a gambling company. Now, what really happens is there are a few people whom we look up to and say that, what, is this compliant with my values? And if the person says so, you blindly follow that. There needs to be a little bit more work going behind that, as to what is the reasoning behind this person or this entity saying that this is a compliant as per your value system. And you have to dig slightly bit deeper to understand this. Now, this may be slightly overwhelming for you in terms of the number of errors which we make, but I've tried to summarize as many as I can. There may be more, but these are a few of the top ones. So what are the financial asset classes which a person can actually invest into? So what I've done is, this is a gauge which I've made, whereby on the left-hand side, there is low risk, low return. And understandably, as you go higher on the risk, you expect a higher return. So right at the lowest risk is precious metals or commodities. I'm saying, I know that I can be pulled up for this, but I really want to bring in, this is physical gold, right? Physical gold is one of the most safest assets you can get, because institutions, countries, sovereign funds, in case of crisis, move to gold, right? And understandably, if it is the lowest risk asset, it's going to give you the lowest yield returns, which means that if you own a bar of gold, you're not going to get anything out of it, just apart from the pleasure of owning that piece of gold. To debt or deposits or bonds, for people who are value neutral, this is fine. For people who are value conscious and did not want to invest into instruments which are interest based, there are options called sukuk across the world. Unfortunately, in India at this particular point of time, you don't have many debt instruments, or rather negligible debt instruments which are compliant as per value system. Real estate is the third most safest asset which you can find. Obviously, this means physical real estate. There are REITs, there are joint ownership platforms and stuff which have come through. And I'm taking this just on the basis of, I'm not categorizing it in any way. There are various risks which you need to look at later on, but on a basis of as is, this is if we were to put it, this is how the risk profile goes. Alternatives are asset-backed investments. One of our companies, Rehbar Financial Services, does a lot of these alternative assets, which is a sort of a leasing company, whereby you have a portfolio of assets, and when you invest, the money is asset-backed, which means that in case you would get the revenue proceeds from that particular asset, and in case the person does not pay the lease rentals, the asset is taken from him and given off to somebody else. So the risk is low, but the return is relatively all right. Moving on, equities. Equities means shares of a company. This is just to simply put it, if you buy one share of Reliance, you are one millionth share owner of Reliance. The price of, if the company does well, the price of the share goes up. If the company does badly, the price of the share comes down. But nevertheless, in a normal case scenario, if you look at it a lot longer period of time, equity would generally give you a return of, you should be happy with a return of about 12 to 15 to 12 to 18% kind of a return. Private equity or venture capital is slightly bit more higher on the risk side. And as a venture capitalist, just to explain it in very simple terms, what we as venture capitalists do is we take a seed and we put it in the ground and we nurture that seed. We put in manure, we put in water, and that seed ideally would become a plant, and from a plant it will become a tree. Considering you are right, you are taking the risk of whether the plant will come out from the seed or not. You are entitled to significant returns from when the plant really comes out. Derivative instruments are the highest on the risk because they are leveraged instruments made on all these kind of things. You can have derivatives on commodities, you can have derivatives on debt, you can have derivatives on real estate, alternatives, equities, and so on and so forth. So what does this mean? Very simply, if I buy one share of Reliance, I can invest 100 rupees in this share, and say probably I get a 10% return from this. I'm not happy with this 10%, right? I want to make more. So what I do is there are derivative created on it, which means that on my money, if I'm investing in Reliance, I will get 400 rupees more from the bank to be invested in the same asset class, which means that now I can buy 500 rupees worth of Reliance shares, 100 of my own money and 400 of the bank's money. Now, what I have to do is, if I make 10% on the Reliance share as is, I will make 10, 10, 10, 10 on it, right? Because I've got 500 rupees of shares. Now, if I make 10, 10, 10, 10, I have to also give the bank some interest out of it, right? So we'll take away, say, probably 5% from each of these. Now, what happens is then I make 10% on my own money and 5% on every 100 rupees which was borrowed by me and invested in Reliance. So I make 10% plus 5, 15, plus 5, 20, plus 5, 25, and plus 5, 30. Now, this seems to be very good, right, in an upside scenario. But in a downside scenario, you are going to be you're going to even lose the money which you have invested, because the bank would ideally want their money back, and hence they would take away whatever you have. So it's a two-edged sword. And in most situations, derivatives are instruments which are not, not inconsistent with the value or with a lot of people's value systems. Now, these are asset classes which will give you returns from commodities, which would give you almost no returns. Debt, which will give you returns from anywhere about 5% to about 8-ish%. Real estate will give you a rental yield for, residential real estate for about 3-odd%, commercial real estate for about 6-odd%, sometimes even higher. Alternatives will give you anywhere returns from about 8 to 12%, equity from about 12 to 18%, private equity, venture capitalists a lot higher, and derivatives, you can just name it. What you need to do is you need to see where you are. You need to understand the risks associated with whatever investment you are going to make, right? So what are the risks? One, price movement. So if a Reliance share goes up one day, it will come down the next day, go up, and so on and so forth. Now, are you in a position to be able to lose 10% and still hold on with the hope that it will make another 10%, 15, 20%? That's the risk which you need to understand from price movement. Issuer risk. When a Reliance share is there, the issuer is Reliance, right? When the government of India gives you a bond, the issuer is the government of India. Now, governments are generally known to be risk-free. And hence, anybody who is a private party has to give you a much higher return for you to take the risk. And hence, you need to understand what the issuer risk is. So whether it is the government of India, which is giving you a paper saying that I owe you money, or is it some Mansoor Khan who's giving you a paper which says I owe you money? So you need to understand the risks associated with this regulatory structure. Regulatory structure means, I'll just give you an example of the venture capital fund that we run. We are regulated by SEBI. What does this mean? That everything that we do, right from collecting the money to storing the money to deploying the money to getting back the money, is all overlooked by the Securities Exchange Board of India. All right. Now, what this means is that in most situations, investment schemes which are regulated will be relatively safer than a similar unregulated scheme. That does not mean that an unregulated scheme is bad, right? It may be still be good, but you need to understand that there is a higher risk associated with it. How do you mitigate this risk? You need to understand who are the people behind this particular investment proposition. What have they done before? Are they trustworthy? Are their auditors good? Are they transparent in whatever they're saying? So you can also invest in unregulated schemes, but you have to be aware that you have got no recourse, right? Or you'll have to just stand outside their offices and ask for your money. Liquidity means that how easily can you get your money out, right? So you need to understand whether an asset is, easily, if I present this piece of paper, when I get my money back, or is it going to take me 5 years, 10 years, etc., etc. All of this you need to assess with your life cycle where you are. So if generally younger people tend to take a larger risks, because what really happens is that you have the ability to recover your losses because you're working. But for a person who's retired, you don't have the ability to recover these losses, if at all. So generally, people tend to lean towards lower risk when they age more. Nevertheless, I have seen extremely old people with super risk, and they say that, we've lived our lives. We want to dabble with venture capital, private equity, derivatives, equity, and whatnot. Moving on, what are ethical investments? So ethical investments, as an international body called Social Investment Forum says, it integrates personal values and societal concerns with investment decisions, right? For people like us who invest in lines with their values, which means that we will not invest into anything which is socially irresponsible, right? And a lot of it is got to do with the kind of faith we follow, right? So in a place like India, Jains follow a value system, Christians follow a value system, Hindus follow a value system, Muslims follow a value system. What is your value system and how do you go about your investment is what ethical investments are. There are a lot of agencies which actually stamp your investment as an ethical investment or not, and so on and so forth. Just to give you an understanding, we at Mount Judy Ventures are signatories of the UN Charter of Principles of Responsible Investing. And this is one entity by the UN which basically certifies you as responsible investors. So why and how does one go by executing a plan, right? And why does it need to be get done? This is one of my favorite examples, and I really urge my friends from the business fraternity to actually look at this very to concentrate on this significantly, right? Now, you go through business cycles. If your assets, if your properties, if your investments are all stuck in the name of the business or in the name of an extended family, it is bound to create problems for you, right? Because what really happens is that when you go through business cycles, if you are caught in a trough, you've had a problem. There are family disputes which happen and brothers fight over each other for properties, for assets, and so on and so forth. There is also a significant problem which people have been facing, which is freeze on assets. For some reason, a court passes an injunction saying that, all your business assets are frozen. Your family is going to be on the ground, on the streets. So what you need to do is you need to create assets in different names. One, separate from your business, separate from your extended family. And what you need to do is you need to create structures accordingly. A lot of wealthy people across the world do this, right? What they do is they do business. And from the business, they carve out certain portions of money every year to create something which is called a family office. As the name says, this is a kitty for the family in case the business does not do well. So it's a de-risking mechanism, right? And a lot of people, extremely wealthy people whom I've seen, don't have these structures in place, which I significantly, urge them to actually create these structures, or at least, invest in different names for the family members. Goal planning, goals can be short, medium, long. Let's try to understand how, you can actually break it down. All right. And what are the kind of instruments which you need to take into consideration? So there are short-term goals. Like example, my son is going to go to university next year. I need this money to be safe, yet I cannot let it just give me no return. All right. So I will try and park it in, I have to have it liquid, and I have to keep it in a low risk instrument. So deposits or gold ETFs are some of the best options for me. Let's look at something medium term. So say probably my daughter is 15. I would want to get her married off at 20. I don't know whether she'll agree, but nevertheless. So we've got 5 years to work with. So here you want it to be relatively liquid, but you need to take medium risk so that this corpus of money earns you some return. So you are okay to park it in equities, or on the lower end, you can park it in real estate, which you can get out of. From a longer term perspective, so I'm planning for, say, probably my retirement, which is going to be, inshallah, 20 years down the line, right? Now, when it is 20 years down the line, I've got a significant time, right? I've got 10 years or 15 years or even, longer. At that particular point of time, I can invest into riskier investments, which will going to give me significantly higher return, because I can't let this corpus just return me whatever 5% or 7%. I have to take on higher risk for me to be able to do it. And hence I can invest into private equity, I can invest into venture capital, I can invest into real estate. Emergency and illnesses, this is one of the most areas where people are ignorant about, where, God forbid, cancer is something which is affecting a lot of people, and the expenses associated with cancer are significantly high, anywhere from range of about 10 lakh of rupees upwards to crore rupees, and so on and so forth. A lot of scholars have allowed general insurance within the value system, or for some people who are extremely bit more conscious, they can look at medical membership. What this means is that you can buy a membership from a particular hospital, and in case you fall ill, they will actually entertain you till a particular amount of money, right? Or you create a corpus of money which is relatively risky, relatively liquid, but medium risk. That means you can create a corpus of 10, 20, 30, 40 lakh of rupees, which is in equities and deposits, which you can remove it, God forbid, if there is an illness, or you can let it run as is. Debt and estate planning. In emergency or illnesses for people who are outside India, obviously there's something called family takaful, which you all can look at. Debt and estate planning, as I mentioned to you, that is an eventuality. It will happen, but a lot of people don't plan around it, right? One is for value neutral people, there is insurance. For people outside India, there is an instrument called takaful, which can allow you to have the same benefit of an insurance plan. And most importantly, even if you don't take insurance, create structures or create pools of money or pools of assets which your family can depend upon, and create a structure around it. As I mentioned to you, if you're buying a property, buy a property, no problem. But keep it in the name of your heirs, or make a will which will allow your heirs to inherit this property seamlessly, right? A lot of people, as I mentioned to you, they create family offices or trusts to ensure that this money seamlessly goes through to their heirs. So this is just a small listing of what are the kind of instruments, how you can plan, and so on and so forth. What I will do is I will move on to the next section of our presentation, which is a panel discussion with two wonderful people whom I've got to know over a period of time. And I'm very proud to say that these gentlemen have been my mentors over the last 5-10 years or so. Mr. Sherif Kottapurath, who was the chairman of Rehbar Financial Services and a managing partner at Mount Judy Ventures. He has close to about 4 decades of experience in the IT and the finance industry space. He was the ex-CTO of Sun Microsystems and one of the first employees at Wipro. He's been a serial entrepreneur thereafter. He has been an alumnus of BITS Pilani. Thank you, Sherif Saab, for making the time. It's an absolute pleasure to have you. My next panelist is Mr. Kazi Arif Zaman. Kazi Arif Zaman is one of the young Turks in the finance space and has had great achievements over the years. He currently manages his own portfolio of investments, his own family office. He has 25 years of experience in private equity and investment banking. He is the ex-managing director of Everstone Capital, one of the largest private equity funds in India, and he's been a director at ICICI Venture and ANZ Investments. He has studied at IIM Ahmedabad and IIT Kharagpur and has a CFA charter. He's a CFA charter holder. Thank you, Kazi bhai. It's an absolute pleasure interacting with you. So at this particular point of time, I'll just take a slight pause, and if you all want to put in certain questions in the Q&A box, please feel free. I'll start with Sherif Saab. Sherif Saab, your journey started as a technologist. There are a bunch of people who, amongst the audience, are from the technology space. How has your investment journey been? Was it easy for you to invest whatever corpus of money which you had, and how easy or difficult was it for you to invest in value-based investments in places like the US or India? Sherif, you're on mute.
Thank you. So first of all, thanks for inviting me to this webinar. I see that there are 170 plus participants, and I'm sure whatever you have presented so far will be of great use to all of them. I wish there was someone like you who had made this presentation to me 40 years ago, because I've gone through almost all the mistakes that you have put in there. First of all, I was totally oblivious of the need for investing. The monthly salary used to come. At that time, 40 years ago, when you get a job in India, it's considered a job for life. So, the company will take care of whatever I need. I don't have to worry about my own, wealth. So I worked in India from 1982 to 1991 for 9 years, 10 years. And I had zero savings except for what was forced by the government through the Provident Fund. Okay, so that was the extent of my savings and investment during that period of time. Even after going to the US, the only difference was that in US, because of the stock options, especially in the IT industry, so I used to get a regular stream of equity in the company in which that I was working. So that equity used to keep accumulating in my kitty, and I just let it accumulate because the prices were going up, things were looking good. My value, at least on paper, has been increasing year over year. I was quite happy. Luckily, at that point of time, I decided that I had enough of renting out. So let me sell all the stocks and buy a house for myself. And by the grace of God, I got sufficient money there to be able to purchase outright a house in the US. So that was a real estate investment that happened, not by plan, but just by fortuitous circumstances. And after that, I still continued accruing the stocks. And then my mistake was that I had all eggs in the same basket. And I really didn't bother looking for any other investment options in the US. And initially, even in the US, the ability to be able to invest as per one's values were also very limited. Even though around the time that I was coming back, and after I came back also, there are a lot of such options which have opened up there. in terms of funds which manage your cash for you, the PEV, VC industry, and so on. I came back to India, and that's when the basket fell from the head, and whatever I had accumulated there, 90% of it disappeared almost within 2-3 months. Okay, so I've gone through almost all the mistakes, and that's when I decided that I need to really start looking at how do I diversify, how do I keep my investments in various buckets. And I started looking at alternative finance options in India. I started looking at the equity markets in India, and that's what actually prompted me to get smart people around me to start Rehbar Financial Services and later on Mount Duty.
Fantastic, sir. I'll come back to it, but I just Kazi bhai, if I can, a lot of the people here are and India overall, we've always looked at real assets, right? And we've always wanted to invest in a real estate which I can, worst case scenario, I can go and stay in, or I can rent it out, etc., etc. Or gold, which I can physically see and just have the pleasure of owning that piece of brick. Now, over a period of time, over the last decade or so, this change has happened whereby there are paper assets which are representing real assets. Can you break it down for us as to how does this work, right? Real assets versus paper assets.
Thanks, Ebaad. So first of all, thank you for inviting me here. Pleasure to be here. And I see the presentation itself was very, very interesting. And like Sherif Saab mentioned, I too would have probably enjoyed and appreciated this presentation at the earlier stage of my career, where again, I made many of these mistakes, and I fear that many of us, despite being aware of these, will continue to make these mistakes also. So all the more important to just be aware of our biases and weaknesses, and therefore take more care. But yes, I think it's true that you now have a much wider availability of investment avenues. So real estate in particular, and I was speaking to one of my older aunts who's about 80 years old yesterday, and she was mentioning that her husband had invested in land in the 1960s, and that gave them good returns. Now, that was true for that era. Now, when you're talking about real estate as an investment avenue, we have to keep in mind that in that era, the alternative investment avenues which give you similar returns with maybe similar risk were not available. But in today's world, you do get investment avenues which could be consistent with your value systems, which give attractive returns without the disadvantages of something like real estate. Now, what are the key disadvantages of real estate? First of all, it's lumpy, it's concentrated. Effectively, all your eggs are in one basket, unless, as you mentioned, you go through a REIT or through a real estate fund. And those then mean that the moment you get into more complex investments, you have higher cost structures, and those act as a drag on your returns. So if you're investing in an apartment or a house, then these are not passive investments. They're active investments in the sense that you better get all your due diligence right so that you have clean title. You better get your asset selection right. Are you investing in the right micro market? For those of us in Bangalore, I think all of us have been reading these stories in the last 1 month about people, including millionaires who had bought villas and apartments in very plush locations, which all got flooded because they were unfortunate enough that micro market is an area which sees flooding. And these are people who've probably put their life savings. In some cases, if they've borrowed a mortgage or taken bank finance to purchase those houses, maybe the amount they have, the capital at risk they have, is more than their life savings. And those are inherent risks in real estate, which is where I would argue that the investment in your primary residence is maybe you can argue it's part investment, but it's equally a consumption asset because you're going to be living there. But where you have surplus assets and you're investing in real estate because you want rental yields, then that is active management. You have maybe again, lockdown happens, people move back to their hometowns, and suddenly your flat is vacant, you need to find a tenant, rentals fall. All those are risks inherent with real estate, which we should be cognizant of. So again, for some people, it may be a fabulous investment. If you have the ability to pick the right micro market, if you have the ability to negotiate the best deal, if you're lucky enough to have good tenants, if you're lucky enough to be able to choose commercial properties with good tenants, even better. But it's not for everybody. And it's certainly not for the passive investor who wants to sleep peacefully at night without worrying too much about what he's doing. Because if you're investing in rental properties, and keep in mind that you're an owner, you're effectively a small business owner. So your apartment does the seepage, say, in the ceiling, then as the owner, you're responsible. Your tenant is not going to take care of it. So financial assets do have an advantage over real assets. Gold is slightly different. So the way I look at gold is more like what in financial jargon we would call a hedge. So you could say it's a bit of insurance about tail risk, about things going wrong or extreme events happening. But gold prices have been volatile. So for the longer term, gold has been a source of value. It's been a source of value for over 3,000 years now. But at the same time, if you are looking at gold as an asset where you're tracking its price day on day, week on week, gold prices can be volatile. In fact, for those of you who are tracking it, then I think gold prices in Indian rupee terms actually peaked over 2 years ago at almost 55,000 rupees for 10 grams. Right now, it's maybe around 50,000, maybe slightly below 50,000. So it's not as though gold is a risk-free asset, but it's an asset which is what we would call uncorrelated to other assets. And therefore, it in an overall portfolio context, it certainly merits consideration for some amount of allocation. So I'll pause there. I think that was a rather long-winded answer to a short question, but I hope I covered the key points.
Thank you, Kazi bhai. Thank you, Kazi bhai. Coming to you, Sherif Saab, the kind of the institutions which you spoke about, and by God's grace, which we are part of as well, how did you go about them? Right. So you've been a flag bearer of all these institutions. How did these come about, and what are the kind of products? If you can help us in a very short way, what are the kind of things which they're doing? Again, Sherif Saab, you're on mute.
Thanks again. So most of these came about as a result of discussions with others, and the when other people express that they don't have the ability to do certain things because of Indian rules and regulations. I've always felt that it's not that the Indian regulations are preventing us, but that we have not put enough and sufficient thought behind it in terms of how we can go about doing things within the Indian legal framework. So if we have talented youngsters, talented professionals who can put their mind to it, then certainly we can work out ways in which we can have investment options which are compliant with our value systems and also compliant to the Indian legal thing. So to give us slightly longer answer, one of the first things that I got involved when I came back to India was something for interest-free microcredit for people in slums. So there's an organization called Lifeline Foundation, which was identifying ladies in slums and providing them with 5,000 to 20,000 range of capital to start off their own businesses or to improve the businesses that they were already doing. And this took in a lot of learnings from the Grameen Bank model, adapted it the way we wanted, and we started doing this. As this progressed, we kept getting requests from the ladies who were participating. This was purely for women. That the ladies started coming and asking us, why can't you do something similar for our husbands? I mean, they have slightly bigger businesses, their requirements are slightly larger, but something of this nature would be great for their business also. And simultaneously, we were having conversations with the young professionals who have just migrated to Bangalore, most of them IT professionals, as to what are the avenues and opportunities that they have for investing their savings in something other than fixed deposits or the bank interest bearing instruments. So after a lot of brainstorming, we decided that it should be possible to do a profit sharing instrument where investment is provided to a businessman who can then use that investment to improve their business, and a certain percentage of that profit is then given back to the people who did the investment. So a partnership model, basically. This went through multiple iterations based on the feedback that we got while we were doing, implementing this, plus because of changes in the Indian legal framework. As the Indian rules change, we had to keep adapting so that at no point of time are we breaking the Indian law while doing this business. So the success behind this is basically the kind of effort which have been put by professionals in coming up with these products and models, which are suited for both the investors and the businessmen. For investors, there were a few options available. I mean, there are even now there are ethical, mutual funds, which is one option for investing. Then you have real estate as a possibility, but there are a lot of negatives in each of these. The volatility in the equity market and the fact that you don't get a regular income from that was one issue. Real estate, your money getting stuck was another issue. The second problem with real estate is that you have to have a sufficiently large amount of money before you can participate. And if I have just 1 lakh, I can't go and participate in any joint venture or real estate thing in Bangalore. That's out of question. So the services that we provided were for someone who is able to save only 1 lakh. Over a quarter, let's say every quarter I'm able to save 1 lakh rupees. Or even every year. I mean, even those people can invest in this and get the benefit of not keeping this money idle in a current account or in a savings bank account and then giving away the interest that is accrued on the savings account. So that is from the investor perspective. From the business side also, people who don't want to approach banks and who want to be able to do business and improve their business are now able to come to an institution and then provide their requirement, their project plan, get it evaluated and get an investment for a reasonable return, where they're not squeezed, that even if the market goes down, the COVID pandemic, their business suffers. And so we don't sit on top of them like the banks and say, give me my flesh of my pound of flesh. So that's that was the goal behind Rehbar Financial Services. And by the grace of God, we have been able to achieve a lot of what we set out to do. There are still a lot more that we would like to do, but the fact that so many people are participating in this shows that it is providing value at least to a large set of people. I hope that answers.
Yes, and Mount Judy Ventures, Sherif Saab, your stepson.
I seem to be spending more time with my stepson than with the others. But so, this again in a similar fashion. When Rehbar was doing, was interacting with the investors, they kept telling us that, we want to give you a much larger amount, not these small amounts. And can you manage it for us? That was one requirement. The second was that when people used to approach us in Rehbar Financial Services with a startup, this thing, which has just been around for a year or 2 years, Rehbar would not invest in it because Rehbar required a track record to know that the person knows the business, can provide the cash flow that's required to pay their dues or lease amounts and so on. So that was the point at which we said something like a VC fund actually suits the requirements much better. That is one. The second is that this is the vertical or the domain where the maximum growth is being seen in India, and not doing something in that particular domain would be foolish on our side. So it is essential for us to be able to, get our feet wet and then, jump into the pool and, benefit from the venture capital, the startup ecosystem that is being built in India.
True. Thank you on that, Sherif. Being on the startup ecosystem, Kazi bhai, there is this whole talk about funding winter, and there is this whole talk about the inflation climbing up and central banks raising interest rates, and the R word of recession coming around, or global recession coming around. Can you break it down for us as to from a normal bloke perspective, what is really happening here, and how do we as normal people invest our money so that, one, it is protected, if not, we thrive in this kind of a situation?
So Ebaad, I think this is a absolute $1 million question. So if we all knew the answer, I think we would all be in a very good place. So I think there are a lot of people and a lot of experts also, who are not quite sure how to navigate these sort of markets, because in a sense, they're unprecedented. Now, I'll take a step back. The first thing is that all of us need to understand that business cycles are perfectly normal. So business cycles have always happened. They've happened for many, many years now. And there's nothing really unusual in the fact that boom cycles are followed by bust cycles. That recession is something which happens every few years, and it's nothing to be scared about. This time we have a slightly more different situation, where central bank interventions to actually control the business cycle have actually led to a point where the business cycles are no longer following their normal pattern. So earlier you'd have a recession every 5 or 6 years, people would get over it, and you'd return to good, healthy economic conditions. Now things are a bit different. And that's because central bank intervention, with all good intentions, has suppressed the laws of economics to the extent that the central banks around the world and the governments around the world, particularly in the first world, in US and Europe, have taken such excessive amounts of leverage that even a smaller increase in interest rates, which is what's happening today, actually is setting off a cascading domino effect, where there are all sorts of unintended consequences, and some people who are so far removed from that world are finding that they are the victims of economic bad news. And for people like us, for people who are sort of sitting thousands of kilometers away from the US, half a world away, the fact is that in a globalized, interconnected world, everybody is affected. So the first bit really is that how do you look at managing risk in this sort of environment? And really, there are many risks. The biggest risk here is actually not risk to your investments, it's risk to your career. Because if there's a global slowdown, then inevitably many people will unfortunately lose jobs. Increments which we took for granted, bonuses which we took for granted may not be forthcoming. And really, the best way to manage that risk is to be aware of the risk, cognizant of the risk, be up to date in skill sets, so that in an unfortunate eventuality, you can still land another job. And at the same time, most importantly, live within your means. And live within your means certainly means avoiding, for those who, many youngsters today actually feel that there's nothing wrong with taking debt, large amounts of debt. So you have people who have credit card debt. You have this new product called buy now, pay later, which you're bombarded with. You see that, why not buy that 50-inch flat TV on installments? So all those are actually dangerous practices, which mean that you're that much more susceptible and that much more vulnerable in a downturn. So I would actually sort of say that that is really the first thing which you really need to look at the mirror and feel comfortable about, or see how you can do better on that aspect. In terms of investments, really diversified basket of investments with the right allocations is something which is important to maintain. If you're not over allocated to anything which is very risky, then I think by and large, yes, there will be pain, but hopefully there will not be fatal accidents. So I'll pause there, Ebaad, and again, if there's anything specific you want me to take up on any of these are the sort of things we can speak for 3 hours or 4 hours and not cover the topic.
No, so things like in this kind of a scenario where interest rates are being increased by central banks, now an Indian citizen also has the ability to invest outside India. Obviously, it's a little bit more difficult, but you have, the world is your playground, right? Do you think that debt funds might be a good idea internationally, or you think diversifying your currency? Currently, everybody is worried about the rupee depreciating the way it is. Just holding some assets which are risk off, but still would hedge you against the depreciation of the rupee. Is that a good idea at the moment?
And absolutely, Ebaad. I think what you're saying makes complete sense. And while the regulations in India now allow us to invest overseas and to hold overseas assets, I think even without going through the very complicated liberalized remittance scheme, which could complicate your tax returns and all of that, even for those who just as simple retail investors in India want to invest in dollarized assets, you can go dollar long in your portfolio without actually having to remit dollars overseas. So what I mean by this is that suppose you do invest, say you want to invest in the NASDAQ. Now, the NASDAQ has taken quite a beating. At some point, maybe it becomes a value buy. Some people, you say that, okay, it doesn't matter. NASDAQ is probably the index or the exchange where there's maximum innovations. If you want to be long innovation, invest in a NASDAQ exchange traded fund, something which tracks the index. And you have Indian mutual funds which do offer that product today. So you can actually go long on that asset class without actually having to remit dollars overseas or worry about having an overseas brokerage account, or without having to worry about, how do I choose which stock to invest in? I know nothing about US markets. So those opportunities are there. Even within Indian equities, there are ways of going dollar long. So for example, if you are long a basket of what they call Twitch now, which is TCS, Wipro, Infosys, Cognizant, or HCL, then in that also you are actually going long on companies which will be benefiting from a weaker rupee, given that they have their rupee revenues in dollars. So in a sense, the Indian IT industry is an industry which is more long dollar than many other industries elsewhere.
Sure.
So you can construct those sort of portfolios depending on your level of sophistication and your risk appetites.
And what I've learned recently is this, that even if these assets are may not be in line with your value system, they can actually looked at by consultants and be told that you can actually take out a certain portion of this particular return which you make as something called sterilization, and the rest of the return can be yours with you being at ease that this is in line with my value system. So that is also some things which the audience can actually look at. Sherif Saab, I'm going to come to a very controversial topic in Bangalore, is Ponzi schemes, right? And how what's your view on these, and how do you spot these? And Kazi bhai, I'll come on to you just a little later. If a sophisticated investor like yourself does even come across these kind of Ponzi scheme, and how to spot these. So Sharif sir, first with you, how do you spot these, and how do you ensure that you stay away from these as an institution builder? How do you ensure that your people stay away from these?
So, most of the Ponzi schemes come with very clear red flags, and it should be very easy to spot those red flags. Right? The Ponzi schemes depend on a few things for it to survive. One is that they have to give returns which are much, much higher than what the market normally returns. Okay. The second is that they start giving returns very fast, because they need the initial positive feedback to come in, so that they can lure more and more people to invest into the Ponzi schemes to keep it alive. Right? So what I normally tell people is that if someone says that they can give 30% return, 50% return, 60% annualized return, and so on, in my mind, there are only two kinds of industries which can provide that kind of a return. Okay. One is something which is addictive. So if it's like, they get you addicted on drugs, they get you addicted on alcohol, they get you addicted on something, and then you are forced to buy at whatever price, and they can jack up the price and they can make whatever profit they want, right? By reducing the supply of the addictive substance. And the second is the one where you're doing something illegal, so that most others cannot do it. I mean, the law-abiding citizens cannot do that business because you're doing something which is illegal, which involves probably a huge amount of bribery and a lot of other
not payment of taxes.
Whatever.
Yeah, sure.
Even by evading taxes, I don't think you can still get 50%, 60% return.
Yes, true.
Right?
True.
So it has to be something even more than that.
Sure.
Okay. So I don't think either of these will fit in with the value systems of anyone who is logged into this particular webinar. So
but they come with the tag. They come with a tag of value. They are value in lines with everybody's values.
Right. So if you are willing to get people addicted, if you're willing to be illegal, then lying is the least of their concerns. Right? Or putting out a false this thing is the least of their concerns. So that and the third this thing, which I wouldn't say is a flat out red flag, is that they would be selling something other than their major investment. I mean, I'll give you examples. I mean, so you take the Sharada scam case in West Bengal, right? So it was all, how was it marketed? Through movie stars, through the politicians, through the influencers, and so on and so forth, without really telling what the underlying business and underlying where are they getting their profits from. You take the various Ponzi schemes in Bangalore that we are all familiar with. They were marketed with the holy books and an attire which are nothing to do with the base business that they're doing. But the front that they give is of someone who's extremely pious, someone who's extremely God-fearing and would not do this thing. But when you try to find out deeper into what they're doing and want to do the maths, none of those things will add up. But so if first of all the returns that they're promising itself is high, I don't think there is even a need to dig.
Sure. So what you're saying is that you look deeper and you evaluate an investment on the basis of commodity. Understand whether they're going to be able to deliver that. Kazi bhai,
Ebaad, let me just add one more thing.
Sorry, please.
So what I'm saying is that you don't even have to go into that, because if somebody is able to give 50% or 60% annualized return, okay, and they really have a business which can give 50 to 60% return, they're not the only geniuses who are born in this world, right? There will be others who would be doing something similar and be making similar profits, and the market competition will automatically bring it down from 50 to 30, 40 to 30 to 20. So there is a certain market level at which you can expect these returns, and a small plus minus on that is okay. Yeah, but if somebody understands finance very well, if somebody understands how to look at books and look at the returns, balance sheets, P&L, and so on and so forth, yes, let them go and dig deep. But I don't think everyone can, do that. Yeah.
Kazi, a swab investor such as yourself, do you even come across these kind of Ponzi schemes, or is it you're immune? You are far away from all this.
And other Ponzi schemes all around us. I think let's be candid here. So, which is that the human nature is such that there's always somebody who's out to make a quick buck, and the way the cheats look at it is that they need to find somebody who they can steal from. And so in a sense, the cunning steal from the gullible. So that's been something which is if I can call it, a permanent truth. And just the modus operandi has changed over time and has changed in more so in the last so many years. And we are witness to what's happening around us. So I actually would want to sort of, I'll start with an example, really, a story. So a friend of mine actually came to me very excitedly. And this friend is a batchmate from IIM Ahmedabad, who earlier studied in an IIT. So arguably, he had the very best education that the Indian educational system had to offer. He was very excited. He said, I've come across this person, and he has a options trading strategy, which guarantees you 2% per month without any risk. 2% per month means 24% per annum. What could go wrong? So I told him that it's impossible to get such returns. If there was somebody getting those returns, then he wouldn't need to take 5 lakhs from you. He would be so wealthy that he wouldn't need the 5 lakhs. And so I told him that whatever you do, don't touch this guy with a barge pole. 3 months later, I met this friend at a party somewhere. He said, yes, I didn't listen to you. I put in money, and now the guy's not taking my calls. He's disappeared with the money. So this has got nothing to do with education. This has got nothing to do with levels of expertise. This is all about knowing your circle of competence. If something is outside our circle of competence and it's too good to be true, then the probability is that it's somebody trying to make a quick buck at our expense. A larger point I'd like to make in the context of Ponzi's, but which is equally valid in a more general context, is that there's a very famous book written in the 1970s for investors who are just making a start, people who are not professional investors. And that book is by an author called Charlie Ellis, and it's called Winning the Loser's Game. So the point he makes is very interesting. And he describes investing as a loser's game. Now, what does he mean by a loser's game? So he says that if you look at a game like professional tennis, and you see Federer playing Nadal, then you see that both these professionals are at a level of expertise, a level of talent, where they manage to get away with the most breathtaking shots. They're superbly fit, and whoever plays better wins. So professional tennis is a winner's game. Amateur tennis, on the other hand, is a loser's game. So the amateur tennis player, whoever makes less mistakes wins. So you don't need to have the fabulous drop shot. You don't need to do the great volley. You don't need to serve aces. If you just manage to return the ball across the net within the court, the probability is that your opponent will make a mistake and you will end up losing you will end up winning on his mistakes rather than on your great play. So Charlie Ellis actually explained that for the overall portfolio, investing is like amateur tennis. It's a loser's game. And again, here he says, therefore, even if you just invest in index funds, vanilla products, no complex products, and you actually just avoid big losses, he says you'll do fine in the long run. And therefore, sort of you'll win the race. And if you take that approach, then you don't need to actually do huge amounts of research. You don't need to look at complex products. As they say, finance is one area where vanilla is probably as good as all the fancy flavors. And if you take that approach, then there's no rocket science in it. You want to take you find whichever index you want to track. You have enough value-based indices around the world also. You just make regular investments in those and don't worry about anything else. Over 5, 10, 15 years, you'll be fine.
Very true. I'll just pull up an SIP chart over our discussions and show that an SIP has given a great return over a period of time. And if you can make the 12 to 14% kind of a return year on year for the next 5 years, 10 years, you've got a great return which you've made on your money. Great. Sherif Saab, Kazi bhai, I'll pose my last question before we get into questions. A lot of people in the tech space have taken crypto as an asset class by itself, right? And is it, Sherif Saab, is it really an asset class, or is it just a medium of exchange? And what are your thoughts around it? For a person who wants to invest into this asset class, or should a person not miss this asset class at all?
Well, I might be slightly biased here, but I wouldn't touch cryptocurrencies with a barge pole. Okay, so I believe that at this point of time, it's more of speculation. There is hardly any real value which is being provided by cryptocurrencies. It's not even an accepted value of accepted currency for purchase or exchange or anything of that sort. Once it evolves to such a stage, then one can look at taking crypto and keeping it. But then that would be like buying dollars and keeping dollars in my home, or buying pounds. And in my last trip to UK, I bought some pounds and I kept it. Now it's of no value. But
unfortunate self-inflicted problems of the UK. Kazi bhai has a slightly different view on cryptos. Kazi bhai, could you?
Well, I don't have a nuanced or sophisticated view on cryptos. Very simply, it's outside my circle of competence, which is why I haven't made any investments in it. I'm happy to change my mind once I understand it better, once I feel that regulation allows me to actually ensure that I'm not the victim of a crypto Ponzi. The fact is that if you're just going by what we read, crypto is one domain where probably every Ponzi operator has jumped in, because there's so few people who actually understand how crypto works.
Sure. And if a sophisticated investor such as yourself says that I don't understand this asset class, I stay away. And that's one of the best examples for people here on the call, that if you don't understand something, if the government has not allowed it, you should be very careful. If at all you would want to invest, just do it as as small as an exposure, but be careful, be cognizant of the fact that it might just be a gamble and may not be in lines with your values.
But I just add, which is that a lot of the people I know personally who've invested in crypto are all doing it with the objective of get rich quick. Sure. And get rich quick, as you said, is speculation. You can call it gambling. You can call it whatever you like. But more often than not, it ends badly. And it ends badly with permanent loss of capital.
Sure.